the Goldbergs. The income approach to value. You need to know this formula. Well, obviously this formula is not helpful if you don't know how to get to net operating income. And how do you get to net operating income? That's that before tax cash flow. That's that before tax cash flow formula, right? And so when Marilyn asked me before, why didn't I just go ahead and subtract everything out? Why do I bother to stop at net operating income? Here's our answer. Because to calculate the value of an income producing property, I need to know its net operating income. I've got to have that as a stopping point. And so basically, this is before tax cash flow before I subtracted out my what? What is net operating income? It's before tax cash flow before the what came out? Before the debt came out. So basically, it's another way of saying that debt doesn't matter when we talk about net operating income. We don't factor the debt in. So if you get one of these questions where you're doing the income capitalization approach and they give you a loan payment, what are you going to do with it? Ignore it. It doesn't matter. It's before debt service in the formula. Net operating income comes before the debt service comes into play. We don't care about mortgages when we're talking about net operating income and we're calculating the value of a property. And if you think about it, that makes good logical sense. If your value in a car wash, should it have a different value if somebody bought it cash or if somebody's got a mortgage on it, or should the value of it be the value of it? The value is the value, so the loan doesn't matter.
They might have a terrible rate and you might get a great one, or vice versa.
That's exactly right, and it has nothing to do with what the property itself is worth, right? Is everybody okay? You kind of keyed in on that? So good. When we talk about doing an example, these really just jump right into the math because the income approach is all math. There's no, in the sales comparison approach, we had to talk to you about some things like the principle of substitution and the principle of conformity. There were those topics we had to lecture on a little bit. In the cost approach, we had to lecture you about the different types of depreciation. You needed to know what functional obsolescence was and economic obsolescence. There is nothing to talk about in the income capitalization approach. It's just straight up math. Here's the math. So here's where we are. Here's an example. It says an investment property has the following characteristics. 50 units that rent for $800 each monthly. Well, right away I can see what formula am I going to be working with? That before tax cash flow formula. I can't possibly do an income capitalization approach without calculating net operating income. The only way to get me there is that before tax cash flow formula. So an investment property, it has 50 units that rent for $800 per month each. Annual vacancy rates of 8% of the gross potential income. A 10% property management fee. Annual property taxes of $30,000. And other operating expenses of $58,000. If similar investment properties have generated an annual cap rate of 9.3%, what's the estimated value of the property? So on the next slide, I've just plugged the formula in here because they're asking you for the value of the property, so you need to write down that formula, that T-bar. The value is going to be equal to the NOI divided by the capitalization rate. The good news is they gave us one of those, didn't they? What did they give us in the question? Of those two things that we need to know, NOI and cap rate, what did they just give us? Straight up give it to us. The cap rate. So I don't need to do anything with that other than plug it in. I'm done with that piece of the puzzle. They gave it to me. But they did not give me the what? NOI. They did not give me the NOI, so I have to work to get there. And that's where we're going to plug in our formula for NOI. We've got to calculate that net operating income. And to do that, we've got to go back to this before tax cash flow formula. It's the same math we've done with before tax cash flow. Gross potential income minus vacancy and collection equals gross effective income minus operating expenses equals what? NOI. And isn't that where I need to be? At NOI. That's my stopping point here. So Start plugging them in. 50 units at $800 per month equals $40,000 monthly, but we want to do what with that number? Times 12. Get it to annually. So that's $480,000 a year. That's our gross potential income. And what did it tell us about the vacancy? It's 8%. So if we calculate 8% of the 8% of the gross potential for our vacancy is $38,400 that we're losing. So our gross effective income is $441,600, and you've got all this on your next slide. You're welcome to rewrite it if you'd like, but it's all, if you turn the page, you got it. Okay. And then our net operating income is just going to be that gross effective minus all of our operating expenses. Well, give me some examples of the operating expenses that they gave us. What are they?
Management fee.
Management fee is an operating expense. What else?
And then we've got the annual property taxes.
Property taxes. And then other. So let's go ahead and calculate the management fee, 10% of the gross effective. So that's $441,600 times 10%, $44,160 for our management fee. Is everybody okay with calculating that? Coming up with it?
Yes.
Where that came from? We all good? Okay. Also, we've got our property taxes and our other expenses. So if we add all those operating expenses together, we come up with operating expenses of $132,160, which gives us a net operating income of $309,000. $309,440. Do we have everything we need now in order to calculate the value of that property? Yeah, because we've kept it right up there in the corner as a reminder the whole time. We needed net operating income. We just figured that out, and we already had the cap rate. So plug it in. Value equals the net operating income divided by the capitalization rate. So $309,440 divided by 9.3%. The value of that property is $3.327 million. $3,327,311 and some change for the value of that property. You didn't hit the percent button.
And that gave me
It would. Well, it would give you the same answer, just with less, with the decimal in two.
which obviously was wrong.
Right.
I don't think it was worth $33,000.
Right. That's what I was going to say. It gave you $33,273.12. Yeah. Okay. Everybody okay on that? Again, it's just plugging things into a formula for this one. So let's go back now then and look at the homework that you had. And if we go back up, number 12 asks us to calculate the before tax cash flow. Did we do that one already? No. Okay. So
We did one very similar.
we did one very similar. Okay, that's what I thought. So, and a rental property has 80 units that rent for $700 per month, and during the past year, an average of 5 units per month were vacant. An additional $3,500 in rent was not collected from tenants for the past year, and then they gave us the expenses for the property. Okay. So, if we start with that, for gross potential income, that's going to be 80 units a month times $700 times 12, right? What do we come up with for gross potential income? $672,000 for gross potential.
Yep.
And they told me that. I'm sorry? Sorry?
I said, did we do this before? I said, yeah, we did it on the one we just reviewed before this.
Okay, all right.
Same problem.
It's the same one?
Yeah.
It's the same one? So, well, we'll just run through it again. If we want to subtract out our vacancy, we're subtracting out 5 units a month at $700 per unit times 12, right? And that was what in vacancy? That's $42,000. But they also told us that there was an additional $3,500 that we didn't collect. So we're really subtracting out $45,500. Okay? So 672 minus 45,500 gives us a gross effective income how much? 626,500 for gross effective. And then if we start looking at all of our operating expenses, we've got a 10% management fee. So we would subtract out 62,650 plus all the other operating expenses of $45,000, utilities of $60,000, maintenance of $35,000, and the other of $70,000. So if we add all those together and subtract them out, what do we come up with total operating expenses? How much?
That's after you subtract.
Oh, that's after you subtract. What's the operating expenses? So minus 272,650. And then what does that leave us with, Caitlin? I'm sorry. 353,850 for NOI, right? And then if we subtracted out that debt service of 180, left with 173,850. Is that right? So before tax cash flow equals 173,850. And then number 13 says in question 12 above, what would be the value of the property if the prevailing cap rates in the area for such properties is 9.6%? Well, value is just going to be this T-bar, NOI, over what? The value times the cap rate. Okay, so value is going to equal NOI divided by the cap rate. So the NOI was 353,850 divided by 9.6%. And what do we come up with for a value? 685? 685? How much? 937. Okay. $3.685 million.
So this is how much you would sell it for.
Right. If I was an appraiser valuing that property, I would tell a buyer this is worth $3.685 million.
Oh, so pretty much you just come out all the stuff that comes with it, like the tenants and everything. If you're renting it out.
Right. Because if I'm looking at buying that property, I have to base what it's going to make in the future off of what it's making right now.
Okay.
And that's going to tell me what I'm willing to pay for it. A lot of times as an investor, see, if I was an appraiser, I would be looking at other similar properties to come up with that 9.6% cap rate. I would look at other very similar type properties and what they were producing and what they had sold for to come up with the cap rate. As an investor, I might set my own cap rate. If I'm shopping for this property, I might say, I'll buy anything that has a 9% or better cap rate. So, if I was looking at what I would be willing to pay for the property, I would just plug 9% in there, and that would tell me what I'd be willing to pay for the property.
And I guess, and they can look at the before tax figures, say this is how much I'm making.
Right, so how would you get those figures if you were an investor looking at buying the property? But where would you get the numbers, though? You'd ask the property owner, show me your books. The seller. You say, I need to see your books. I can't make you an offer on your business, your property, without looking at the books. Okay? So number 14 kind of puts it all together. John's an appraiser who's been tasked with finding the value of an apartment complex that has a total of 36 units. 24 of these units have 3 bedrooms and rent for $1,100 each monthly. The remaining 12 are 2-bed units that rent for $900 each monthly. Okay? So let's go ahead and do the gross potential income on this thing. Sure.
Before we had a similar problem to this, how should we look at the piece that says including 10%? Property man, is it included in that 185, or should, I did it both ways, but how should we look at that in the future for the test or whatever?
So, well, let's start working through it, okay, and then I'll address that. Hold on, just let's get to the gross potential income, okay? So, 24 of the units rent for what monthly? 1,100 times how many months a year? 12. Okay, so we also have 12 that rent for 900 times 12 months a year. What do we come up with for the income on both of those? 316. And the second one? 129,600. And if we add those all together, what do we come up with for a gross potential income? 446,400. Right? Sorry, 24. 24. But the math is correct. Okay? Everybody good on that gross potential income? Yes? All right. What do we need to do next?
Subtract out vacancies and collections.
Subtract out vacancy and collections. So, minus, and they tell me that my vacancy and collections, 6% losses. Okay, so it's going to be 6% of that gross potential income. What is 6% of 446,400? $26,784. And then what does that leave us with?
419,616.
419,616 for gross effective income. And we want to minus our expenses, right? The property has annual operating expenses that total $185,000, including a 10% property management fee. I read that it's inclusive of it.
Oh,
Oh, because the last property, that's why.
I would not have read that way.
Wow.
That's included, so I just do it for the one.
Total operating expense, or has annual operating expenses that total $185,000, including a 10% property management fee. So luckily, I just don't even need to do any math there. So if we subtract out our expenses, what do we come up with for an NOI?
234,616.
234,616. And that is our NOI, correct? Do I need to go any further than that? No. They didn't give me a debt service payment, but if they did, I would just have ignored it because they're asking me for the value using the income capitalization approach. And that formula is just NOI over value times cap rate. So the value equals NOI divided by cap rate. So that equals NOI of 234,616 divided by a capitalization rate of 9%. And what does that come up with for a value on our property? 2 million something.
2,606,84,4.40.
844. 606-844.
When it says estimate, do we automatically round?
No. No. Everybody good on those?
I like that.
You don't like the trick word there?
I feel like you can read it. You know, like it's the whole
Right.
112 questions. This is 112.
Here's what I would tell you. If they put that in there, they would not give you an answer choice that would line up with it.
Okay.
They're not going to be that. They're not trying to do that on math questions. They may try to do that on theory questions, but not on math questions. They really do make an attempt to be abundantly clear on the math questions. So
They're just giving you extra information to see.
they'll give you extra information to see if you discard it, but even if you had misread that, you wouldn't have come up with their answer. You'd be like, I did something wrong. And so, you know, okay? That is the income capitalization approach. And that almost wraps up chapter 17. We've got one other thing we want to talk about in chapter 17. There are income producing properties that you just won't have that level of detail for. You just won't be able to know an NOI for it. Specifically, rental homes. If you're buying a house that you intend to rent out, there's a very good chance that it's not being rented currently. So you don't have like an income statement for that property. So you really don't have anything to base the income capitalization approach on. Now, if it's already been rented out for several years, you might have detailed information and you can use the regular income capitalization approach for it. If not, we have something called a gross rent multiplier. And that word gross should tell you everything about it, because gross is before expenses. That means it's very rough around the edges. The gross rent multiplier is nothing in the world but the number of months it takes me to get my investment back, because it's the purchase price divided by the monthly rent. If you look at that formula, purchase price divided by monthly rent equals the gross rent multiplier. So what that means is it's just the number of months it would take to get my money back. If the gross rent multiplier is 100, that means on 100 months I've gotten all my money back. So let me ask you this. If a gross rent multiplier is the number of months it takes me to get back my investment, what's better, a higher or lower gross rent multiplier? Lower. It's a shorter time period. Whereas a gross rent multiplier of 120 would be 10 years, right? 120 months in 10 years. I'd rather have a gross rent multiplier of 60. That means I can get my money back in 5 years. Okay? So, just as an example, in case you see one of those on a test, rental home generates monthly income of $1,450. If the owner investor purchased the home for $172,000, what is the gross rent multiplier? It's just the purchase price of the house divided by the monthly rent. And they can't possibly make it any more complex than that. So you really ought to hope you get one of these as a math question on the exam, because it's like the most straightforward one you can possibly think. I mean, it's literally just purchase price divided by monthly rent. So just to kind of in a theory thing, just to see if you understand it, we said a lower gross rent multiplier is better because it's a shorter time period. What are the two ways that I could lower my gross rent multiplier?
Increase rent.
Raise the rent or
Decrease the purchase price.
pay less money for the property. One of those two things. If I pay less for the property, my gross rent multiplier is going to go down. If I increase the rent, my gross rent multiplier is going to go down. Or do both and really knock it down. Everybody good with that? That is it for chapter 17. Finally. Oof.